Thank you very much. Welcome. My name is David Hostert. I'm the chief economist at BloombergNEF. We're a research business within Bloomberg looking at the transition to a cleaner economy. And before I walk into this presentation, just a bit of background where we're coming from this time. When I joined the energy sector 15 years ago, the things that we're talking about today were very much kind of the new thing, the new kids on the block. And that means that we feel that the pendulum currently is kind of swinging back a little bit. So we came in kind of the 2010s with this kind of new enthusiasm. Then in 2020, all of this got supercharged, and now it feels like we're slightly swinging back. At a time when the previous panel highlighted some of the real impacts of climate change are actually more real than ever. But when you follow the news, you get the impression that things are actually moving backwards. Hopefully, I can convince you a little bit that we are actually moving forward and that things are happening. Just quickly on our product, so the New Energy Outlook is Bloomberg's set of energy and climate scenarios. This is the work of about 70 experts at BNEF, and we do bottom-up modeling to model the impacts on the energy sector from power to transport, buildings, and industry. This year, we updated our base case, and I'm going to show you a little bit more what those results are. And we also looked much more closely at the next 10 years. So when you do these 2050 outlooks, people only care about 3 time zones. They care about the next 5 years, that's your average CEO tenure. They care about the next 10 years, that's maybe the board. And then 2050 is some point in the future. But lots of things are happening in between that. And we wanted to look especially at the next 10 years. The New Energy Outlook mirrors the setup of BNEF as a business. So each of these bubbles is a team at BNEF, ranging from the clean power side to transport, industry and buildings, most recently agriculture, also the commodities. And my role as the chief economist when we do these scenarios is to get everybody together and then hopefully leave them equally unhappy. And then I will have done my job well. We have 2 scenarios. So the economic transition scenario is our base case. This is a scenario that's consistent with 2.6 degree temperature warning. And we are taking an economics-led approach. So this is a techno-economic view of the world where we look at the current policy. We look at the policy that is firm and legislated. But then we make no further assumptions about policy, and we look at technology cost. What are the least cost solutions for us to meet demand, how we move around, how we fly, how we consume energy, and then leveraging BNEF's proprietary data on cost pathways and our modeling capabilities, and a kind of a bottom-up view of the system. We also have a net zero scenario, which is consistent with 1.75 degree. We didn't build a 1.5 degree scenario because we couldn't. And I can tell you now that our next scenario that we're going to publish next year is probably not going to be 1.75, but slightly higher. This is not to say that there's no solution for 1.5, but certainly when we look at the technologies that we have today and kind of don't introduce magical thinking, these are the pathways that we think are credible. And in order to go faster, we would need to see additional technologies come forward. And just finally, before I go to conclusions, when we talk about the energy transition, it's important that we think about countries, because countries are the agents in the transition. So global numbers are interesting, and they often look smooth, but really it's countries where the transition happens. So we cover 12 key countries, for which we also have country-level reports and data across both scenarios, and then 7 additional regions. The first kind of thought I wanted to leave you with is that actually we think energy emissions are beginning their descent. This chart shows you where emissions have historically come from oil, gas, and coal combustion. And we think that in our base case economic transition scenario, they are at the turning point right now, and we see them down 22% by 2050. This is not enough compared to what the net zero transition needs to be like, and you can see this in the dashed line here. But certainly it's better than the top line here, which is our no transition scenario. This is a world where we just continue to consume as we do, but we don't change anything. So if you think about this kind of road to hell up there, then the difference are the colors in between, and these are the things we did to get to the economic transition scenario. So 75% of emissions reductions in our economic transition scenario are based from clean power. Another 9% is based on, 15% is based on electrification. This is electrification of road transport, of industry, of building. And then there's about 7% from energy efficiency. So clean power really is the major driver in our base case. And in order for us to get to net zero, we would need to activate many more drivers on the right. This means that countries are actually in a very different trajectory, and the groups that countries fall in doesn't neatly follow any more kind of old groupings of OECD, non-OECD. we have about 3 categories. There are markets where emissions are still rising and rising fast, and this includes markets in South and Southeast Asia, India, Southeast Asia. There are markets where emissions are flatlining, and that includes MENA, rest of the world, some LATAM countries, and then really emissions are really falling in the Western economies, including China. There's such a huge China story that we can't delve into, but it is really one of the most interesting countries to look at. The second, also the kind of another finding that's important is that actually, despite the news, despite the headwinds that we've seen, and some of them are very real, we have upgraded our technology outlook year on year. The solid line here shows you what our base case view is currently for these key technologies, and the dotted line is what we said last year. So you can see that wind power in the yellow line is up 20% year on year for the next 10 years. So this is kind of a huge upgrade. For solar capacity. For wind capacity, we held a forecast that's slightly up. There are important country differences, but we're really looking at global trends here. Battery storage capacity up by 1/3 globally, so a huge upswing. And then for electric vehicles, our forecast is slightly down. We did actually publish just last week our updated electric vehicle outlook. It is again slightly down, but don't be mistaken, this sector is still in the steep part of the S-curve. For our sustainable aviation fuels update, there's been a pretty significant uptake as well, and this is based on real project, real data. And the same is true for kind of nuclear, which is kind of more or less stable. And then hydrogen moved slightly to the right. We were never that bullish to start with on hydrogen, so we haven't downgraded as much, but it kind of moves slightly to the right. And then finally, for carbon capture and storage, we've taken a 50% haircut. And this is because we now look very deeply at the project pipeline and looking at which projects we think are feasible, and then a few of them drop out. All this has implications for commodities. In our outlook, coal demand is in structural decline, as is oil demand, and gas is the swing factor. So coal demand is down by quite a bit, driven by drops in the power sector. We see oil demand cresting around 2029, 2030, and then falling, and this is really driven by demand destruction from road. You can see that oil demand still rises in chemicals. There's kind of other dynamics here, but the big swing factor is road transport. And then for gas, it can really go either way. If we're entering this net zero scenario, then gas demand goes down. And then if we go in our base state, we still see this glide path for gas based on very cheap costs in the US as well. So the big factors are here, US demand, it's the power sector, and some of the chemicals. The biggest request we got this year to add was data centers, so I thought I should leave you with some of our analysis on this. Data centers were held around as this major driver of electricity demand, but really they're just one of several factors. And whatever you think is true about the world, whether this net zero scenario or the base case or whatever, electrification is one of the big drivers, and electricity demand is growing. So we think electricity demand is up by 1/3 in the next 10 years. And then another 75% in the next 25 years. So huge drivers. And this isn't just one single source. You can see that actually electric vehicles are still the biggest driver of additional demand globally. There's some very interesting regional differences because, as you can imagine, data centers are clustered, right? So they really affect individual grids. If you look at PJM, if you look at Malaysia, there's some very distinct points. But overall, electric vehicles are really the main driver. But other things that you shouldn't underestimate are improvements in buildings, air conditioning, electrification. These are big drivers. So overall, EV demand in the power system goes from about 1% today to 11% by 2050. And data center demand goes from about 1.4% today on average to 4.5% by 2050. But look at the spread, right? There's a huge spread. And this is a challenge for decarbonization because what we find is that as data center demand kind of grows, initially in Europe and the US, but increasingly in Asia, Southeast Asia, and our hypothesis is really that data centers ultimately will have to get built where consumers are. You and I are going to kind of whip out our phone. We want to question AI, and we can't deal with latency. So latency means data centers long-term have to be where people are, and that means the power needs to come from these centers. So when we model this and we input data center demand where we think it's going to be in the 55 energy models that we have globally, then we find that data center demand is really dirty. And this ignores some of the announcement that data centers have made about the procuring they're doing, but it also shows the reality that if a data center with deep pockets kind of buys power, somebody else will not be able to buy that power. So unless these commitments are truly additional, the impact is going to be dirty. And we find that it triggers new gas builds. And we heard about delays in gas pipelines, in gas procurement. There's kind of a huge pileup. The cost for gas engines have really increased in the last 6 months only. But it means that new gas engines get built and that existing coal capacity that would otherwise have shut down is not shutting down. So we're delaying coal closures. And the renewables in the next 10 years will contribute significantly. But all the things being equal, unless you make it that way, data center demand is going to be dirty. Those were all the findings I wanted to leave you with. If you're a Bloomberg client, then there's a whole lot of other data behind this. We have 12 country reports, 18 spin-out reports, and all the input and output data in annual granularity for these countries. And we have our public website as well, where you can download an executive summary. Thank you so much, and I hope you have a brilliant rest of your day.